Today we're going to be talking about how I look at multiple time frames. We're going to review our 12 candle system. We're going to look at some of the best trades from the week. It's the week before Christmas. You don't want to miss this one. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. It's the weekend. We're a week away from Christmas. December has been a fantastic month in the currency markets for British pound and for gold. Again, last week, textbook trade setups, lots of movement. Today we're going to review how I look at multiple time frames, but we're also going to talk a little bit about psychology. We're going to review the entire process, and we're going to answer some questions that have come up this week and clarify some very simple things, and hopefully convey to traders that are struggling or have yet to find that consistency, or missing, they think they're missing something. We're going to really hammer home the simplicity of how everything works, and then understanding about how you need to be patient and why it's so important to be patient and wait for the market to give you the best setups. I would rather take one great trade at size than 10 stressful, mediocre, 50-50 trades that struggle, give me inconsistent trading results, and just end up in the same place next week, the week after. So let's get started. I keep getting questions regarding indicators, multiple time frames, other instruments, cryptocurrencies, indexes, all of those things. Let me clarify one simple thing. Every market works the same. They have different participants, different players, different smart money in those markets depending on which industry or what instrument that is. So obviously if you're trading gold, there may be multiple big players in that market, from producers to financial institutions, central banks, governments, big wealthy private individuals, whatever that may be, because gold obviously is global. Whereas if you're trading the Aussie dollar, for example, there may be only a small group of smart money or big players moving the larger parcels in that market. Central banks, the banks, hedge funds, maybe obviously Australian consumers or people who are in that market who trade in Australian dollars overseas, companies that work with Australian companies, whatever. But that is probably a smaller market, obviously, than compared to gold. What does that mean? That may mean that gold, for example, may move at different times in Asia, London, and New York. The British pound is the last currency of the European nations that kept its own individual currency, the United Kingdom. So there is probably a lot of vested interest and a few large smart players controlling that market. Brexit, maybe even with the European Union, who are going to be dealing with the United Kingdom, there may be a lot of players involved in that as well, central banks, whatnot. But multiple time frames, regardless of any instrument. Today, hopefully this will clarify some things that will help traders. A lot of people say I can't trade during certain times. What should I look at? What time frame should I trade? People like to just trade the 4-hour chart. Some traders like to trade the 1-hour chart. Some traders like to trade end of day. Well, today I'm going to talk about how I look at every single time frame when I'm trading on the 15-minute charts, and how I am viewing that not from a perspective of trading the trends or anything else, but what I'm looking for is who is now in the market. Who has now entered into the market? Have we just triggered a 4-hour bar entry? Have we just triggered a 1-hour bar entry? Have we just triggered a 15-minute bar entry? And again, at some point, somebody's going to be selling too low and get caught at the bottom, and somebody's going to be buying too high and getting caught at the top. And so as the session evolves, as the day evolves, we develop a high and a low. We have the previous day's high and low. We talk about this all the time. So we're going to really hammer down on this. We're going to show some specific examples of why, no matter what time frame you are trading, at some point when you enter into the market, There's a reason why you put a protective stop in, and how when you enter into that market, nobody gets a free lunch. If you look at your charts on any time frame, wherever there is a vertical move, it will usually have come out of a compressed market. That vertical move, whether it's up or down, is the area that I want to be trading in, because those markets move fast and quickly from point A to point B. Now, for those of you who have been following me long enough, you know when these markets move their 50 pips, they're usually over within 2, 4, 6 bars, sometimes in gold, sometimes in the pound, 1 bar. Those are explosive moves. They don't always come out of coiled markets, but they usually come off of the high or low of the day. So when I'm looking at multiple time frames, first and foremost, we talk about the previous day's high and low. So when that bar is broken, whether it's the low or the high, at this point, when a market breaks that level, we now have end of day traders, we have 4-hour traders, we have 1-hour traders, we have 15-minute, 30-minute, 5-minute, 1-minute traders in the market when that bar is broken, if they're trading the break of new highs or new lows. So when that happens, especially when it's the previous day, now we have multiple time frame traders in the market. That is an indication, coming back to what we looked at before, the types of days that Dalton talks about in market profile, where we now have a high probability opportunity possibly setting up, whether that's for a trend trade or a reversal trade. We talked about the 3 things that markets do. They break out, they pull back, and they trend. They break out, they pull back, and they reverse. False break reversal. And then they pull back and they go into a trading range. They just stay range bound, which yesterday on gold is an example of that. We're going to talk about that, because even on a range bound day, we still can involve other time frame traders in the market by the time that market has established a high and a low. So traders keep asking, how do you know if you're at the high or low of the day? Well, I don't know how to answer that other than to say this. If that's the high of the day and that's the low of the day, and you're here, you're not at the high or the low. But if you're here, if price is trading right there, you are at the high of the day. If it's trading right here, you are at the low of the day. The next question is, what time is it? Traders are getting into the market and selling this when we may be in a bar that is in the gap time, which we're going to talk about as well, the gap times. And it may be the break of a 15-minute candle in the second hour of a 4-hour bar. So again, now we could be in a move that could be moving for another 2 to 3 hours in that direction. So again, understanding that we don't just get in front of something and sell it because it's at the high. And in fact, as we mentioned right here, my objective is to sell high and buy low. Now, if this is a trending market and this is a 4-hour chart, I still want to be buying low somewhere in these bars. And within this bar, and we're going to go over a specific example on Thursday on gold, where the market put a pin up through the previous day's high on a 4-hour bar. The next bar opened up and went up 150 pips. Now again, there's people who don't like my whiteboard. That's okay. This is what I'm using. This is what I teach on. Listen to the words that I'm trying to explain to you and take that information and turn it into profit. That bar was 150 pips. It had a 10 pip wick on the bottom. And traders say to me, well, I just buy the break of this candle and get the 75 pip move. Unfortunately, what they didn't see is that on the 1 minute, this was a 75 pip move down that formed a little V bottom and then a W. That 10 pip wick was a 10 pip W at the beginning of the next 4-hour candle that went up to the top of that wick. 75 pips straight up just prior to the US session open. The first candle of the US session 12 candle window hit the wick of the 4-hour bar and did a 75 pip stop hunt straight back down to where the 10 pip W formed, and got the guy who was long on the W, who didn't take the profit off the table. Point being is that when these multiple time frames are triggered, so when they hit the top of that wick, you had breakout traders on every single time frame in the market, and the market within 20 minutes was down 75 pips from that entry. So again, the question I ask myself is, where is the money? You could still buy low and get the 150 pip move. When these other time frames are in the market, that is when we can look at the market in our head timing wise and know who is just sold down low and who is just bought up high. When we are at the high or low of the week and they are working the high in pushes, we want to be sellers up top. Now again, we're not talking about a trend, we're talking about a market that's blowing off at the high or low of the week. We want to be selling up here. Now, to have an M, somebody asked me recently, I'm having trouble finding the second leg of the M. Now my question is this: if there's no second leg, that is not an M. That is an M. That is an M. That is an M. If there's no second leg, there's no M. Now, if you have a market, as we saw again on gold, we'll look at some examples on the pound, that goes through a previous day's low and pulls back with a 3-bar reversal, okay, at the low of the week, or at the low of a day after a strong trend day, the low of the current day, where the market has come up maybe 200 pips, you can get a V bottom reversal. But that's different than a market that's working into the low, as we saw again on gold on Monday. Monday worked into the low, Tuesday exploded for a massive move off of the Asian W. And we'll look at specific examples of that. So the timing window, again, is where we see our 3-hour high and low put in place. Now, if there is already a high and low, for example, we go into Asia and we have a high and low from the US session inside of the previous day's high and low, those levels can now become an area for a stop hunt. Which trade is in the money? Has there been a seller in the market from early start of the day, from yesterday's US session, from this morning in Asia? Has there been an early buyer, or has there been a buyer recently? Is the market working up towards the high? If we have a high and a low, and the market is working up into the high, that's called working the high of the day. If they're working down inside of the low and they haven't taken out the low, as we saw in gold, and the market shifts away, there's a reason for that. Again, the question you want to be asking yourself is, are they working the low for a move up? If you're selling down low, you should be concerned. Now, we're not talking about a market that's rolling over. We're talking about a market that's working into the low. Yesterday is a great example on gold. For 4 hours, they worked into the low without taking out the low that was formed in the London hour before exploding back up for a 75 pip move. But traders who were short were waiting to maybe take profit at the low, go to break even at the low. There would have been multiple reasons for traders sitting there waiting, hoping for that market to break. And there's reasons why they didn't let them out. They will go sometimes 1 pip below a bar. So you can go long, and they come back and they go 1 pip below the bar. That's enough to stop you out before reversing. But if they go further than that, they allow traders to get out with the spread, with profit, if they have their profit target below that bar. So again, you want to be paying attention. Are they working the low for an explosive move up? Or are we in a trend where they're making new lows, pinning through numbers, pinning through lows, and pulling back and rolling over? That is different than working into a level without violating it. These time frames are where most of the movement will occur. Now, in some cases, if the market has already been vertical in the gap times or heading into that session, that next 3-hour window may be where that coil builds up for either a continuation move or for a reversal stop hunt in the direction of the trade that's in the money from that vertical move into that consolidation. Again, the timings, 8 to 11 p.m. 2 to 5 a.m., 8 to 11 a.m. New York Eastern Standard Time. And something I really want to hammer home, and hopefully this will really imprint on your brain, is that as much as you think you're seeing stuff with technical analysis and everything else, you have to understand there's an algorithm running, an electronic market maker that works with timing. And if you don't believe me, put your charts up and start again looking at the timing window. The timing window is so critical, especially in New York, in that equities hour for gold, London obviously for the pound, the high and low of the day, that middle hour when those markets kick off, they're either going to go back to the extreme for the stop hunt or lock in the low or the high for the reversal move or continuation move back in the other direction. So for example, if you're in a down market, London may work up for a stop hunt into the trend for the move back down. So they take traders back in the wrong direction, or they get them chasing the move further before coming back and stop hunting into the trend before continuing that move. But it's very important to understand that middle hour and that equities hour, and that these are electronically driven by algorithms. Timings are critical. Okay, let's review this again. For those of you who think I just cut out a section of the video and you missed something, I get emails about this. I wiped the board off and people think I've deleted part of the video. No, I just wiped the board off. That's all I did. What I'm looking for is that, or that, at the high or low of the day. Now I might be up in Asia, okay? So the low of yesterday could be here and the high of yesterday could be here. Asia and the US might have a high here and they might have a low here, okay? They might be doing this in Asia and all of a sudden I get a pin and they pull it back and it's the end of the first hour and then there's an engulfment. Okay, well, how does it trade now? That's the high for now. But I also know I don't have other time frames involved yet. I may only have the 1 hour, the 15 minute, the 5 minute, the 1 minute, because the 4 hour guy needs maybe, okay, he needs to break that high now for the 4 hour guy to be in. And the other time frame traders at the high of the day aren't in yet. So I wait. But if they give me an engulfment, okay, and they start working back into this level, and we head into London, and there's another engulfment, okay, well now I know this market's working its way down. So yeah, you can trade that, okay, but again, we could be in a creeping trend that's working its way, and eventually it pins through the low of the day from the yesterday, and we get a little reversal engulfment, and it could even be in the gap time. But guess what? Now I know that heading into the next 12 candle window, if I'm not long in here already, I know that we could come up and they could come down 1, 2, 3 reversal for the move back to the high of the day. Okay, once this market has been hit down there, I know again every time frame is involved. And as the day evolves, we're going to get the 1 hour, eventually we're going to get the 4 hour guy in. So again, each bar that gets hit, we know all the time frames are involved. So now we got multiple players in the market and we could get an explosive move back to the other side. Again, as opposed to pinning through a level and working up for the rollover back down. Now again, timing window is critical because that gap time outside of the 12 candle window, so this is it, the 12 candles. People say, well, is the 12 candles before, after? 12, 15 minute bars. Focus on 12 bars, 12 of them. Okay? If you don't get a signal in that window, what are you thinking? I'm thinking there's going to be something happen in the gap time. If they go outside of the high and the low in the gap time, that's where you get some of the most critical information, because now you're looking at a lower high of the day being put in place or a blow off move that's in a strong trend, okay? Or a peak formation being put in place for when we head into the next 12 candle window. That's where you know where you can start putting your thesis together into the next session. So people say, well, I want to trade the gap times and all that. Again, I'm going to emphasize, you can trade anytime you want, but these markets are driven by electronic market makers. There's an intelligence behind all those moves. So again, if you're trading it down and you think it's going to roll over, you want to make sure you're not getting caught on the rollover, because all of a sudden on a 1 minute bar it'll be blowing off, and literally at a specific time, an hour and a half before the US session starts, one little bar will lock in the low or the high, and it will march up as it did on gold last night. And we're going to look at that 75 to 100 pips straight up, and sometimes it just completely defies all of your, well, it does, it defies all of your indicators, which is why I don't use moving averages, stochastics, MACDs. I know some people have, you know, all these mathematical formulas that drive, you know, their indicators, and that's great, but I'm telling you, the number one thing is pay attention to the clock. The clock is the most important thing. Price and time with these algorithms is critical. The high and the low of the day. When they hit the stops, again, understand the psychology. Not only does it flush the money out of traders' accounts into theirs, but it also triggers other time frame traders, which is why, okay, when you have an OT, FT, other time frame traders, all now in the market, where's the most obvious level where the money is? It's at the most recent swing low or swing high, which usually comes from the previous session. So if you have a session high in London and you're buying low for the move back, the first place it's going to go is to the high of that last session. It may blow right through it back to the high of the day like it did yesterday in gold, because that's where their stops are. They put their stops at the high or the low. That's where every retail trader puts their stops, at the high or the low. When I sell after they've done a stop hunt, my stop is one bar, because it may not be at the high, because I might put a 15 to 20 pip stop in, because once I'm convinced they've locked in and they're done, I may put a position in with a 20 pip stop, because the next quarter is 25, and if they go up there, then I'm done. If they go back to that wick, then I'm wrong. I've read the chart wrong. I've got in too early. I haven't waited for confirmation, or I haven't got my engulfment. If I'm on a smaller time frame and I've already got an entry, it'll be a really tight stop. So understand the rationale about how other time frames are involved. So you're using a 4-hour chart, you're a trend trader, you're up 75 pips, you wake up in the morning, it's gone 150 pips in the other direction, you've been stopped out, but you were up 75 when you went to bed. These markets are, when they go to these levels, not only are they hitting stops, but they're triggering multiple time frames getting into the market. That's why I'm always in my head, the timing window, I'm paying attention who's involved. In the gap times, if you're at the high and low of the week and they go outside of the 3-hour high low, that triggers other time frame traders. So for example, Thursday's US buyers in gold, if they're still in that market, if they haven't been stopped out, are still up high as we head into the weekend, and they cannot get out without a loss. And in the morning, and Monday we could be heading straight down. Who knows? Gold may come back up and go up 500 pips, but maybe not till Wednesday. So important. As I've said, I've always end flat. I know I've heard traders talking about, you know, we should focus on 3-month highs and lows and longs and shorts and all this stuff. That's not my psychology. I want to take it off the table today, lock it into my account, and be flat and go to bed at night and sleep. Lock in the pips, lock in the profit, take it off the table. If you study these markets, you'll see once they move a certain range, they'll come back a certain range. They may keep trending, but they're going to keep coming back because multiple time frame traders are in the market. And again, nobody gets a free lunch. So as a move progresses and more time frames become involved in that move, the more likely now it will come back into part of that range, even if it's just a pullback into that trend. It's a stop hunt on some level, whether it's a 1-minute guy for 25 to 50. But again, even on gold in the US session, it can move up and down 75 pips in that pre-market before the equity market even opens. So round numbers, engulfments, pin hammers, a 1-bar stop, 25, 50, 100, 150 pip profit target, depending on when and where that trade takes place. If we've had 3 levels of rise, Asia, London, New York, and you're selling high in that equities hour after a 1, 2, 3, and it's 150 pip move down and it's the high of the week, that market could go maybe 300 pips. But again, once it hits the stops from where that session began, it may consolidate and go sideways. So I'm always watching how fast, what time is it, how far have we gone, have they hit the stops, how is price behaving when it gets there. And again, I don't have any irrational expectations. I have a plan for each session going in. I take it off the table. I don't care if I get 50 and it goes 300. I could care less. I am taking what's off the table. Tomorrow I'll come back and I'll look for the next best trade. Last, in closing, we're going to look at this week's pound trades as well as gold. But I just really want to emphasize, if you understand the importance of this and this and this, you will probably take far less trades. Your success rate will probably go through the roof in terms of not only getting great asymmetrical risk reward trades, but your confidence will grow because you're going to be getting in at areas where you have the highest possibility for asymmetrical risk reward. And again, understanding we are not counter trending the move. The market is telling us that it has locked in a level and now it's going back to the other side. If you are counter trending a strong move, you will blow your trading account up, or you'll get smashed over and over and over again. You'll say this didn't work. If you're getting in too early without that second side, whether that's an extended M, a shortened M, just an M, okay? And very rarely will an M pattern ever end a move in that first hour. So this will often show up inside of highs and lows. It will show up in that first hour, but then you'll see the equity hour come back and take it out. Something Bill McLaren taught me, double tops, double bottoms, lower double tops, lower double bottoms will very rarely end a trend. There will always be one last push through the peak. Now again, if it's a multi-session double top structure, that is entirely different. But if we're looking at a move heading into the equities hour where they've given us that, don't be surprised if that when New York opens, they don't go back one more time, give you your M pattern after hitting the stops. Very important. But if London blows off and at the end of that equity hour, they give you a little double peak formation or a shortened M or an extended M, and at the end of that second hour, it goes 1, 2, 3. Again, remember what that last little 1, 2, 3 does. At the end of an hour heading into the next hour, triggers other time frame traders into the market, buying high or selling way down low before shifting away 25, 50, 75, maybe 100 pips, and they could still go back in that direction. But these traders that have bought low and sold high, bought high and sold low, are underwater. They're either holding on and praying, or they're stopped out, or they're averaging into a trade that keeps going before the next 12 candle window resumes and possibly comes back up or continues to move away from their position. So again, multiple time frame traders. Who's getting caught up high before they sell it? Who's getting caught down low before they buy it? If it's a trend day, those bars don't come back. So anybody who sold low is caught down low, and anybody who's bought high is caught up high if the market's trending away. And again, day 2, level 2, trend day. Now it doesn't always play out because we could have a day 1, a day 0 on Monday, day 1 on Tuesday, and a trend day Wednesday. So day 0, we talked about the narrow range days. But day 2, level 2. People say, well, how do you tell the levels? In my head, every day. Monday's day 1. Tuesday's day 2. Wednesday's day 3. So we're either up high, down low, or inside. So again, if we're working the high, are we in a trend? Or are they putting a peak formation in and working the high for a sell-off? That sell-off may only be one day, but it could be a 150 pip move. And then they could come back on Friday, or they could continue the move or go sideways in an inside bar. So critical to understand the multiple time frame traders, who is in the market, where is the money, every session when it begins, are they working the low, or are they making new lows? If they're making new lows, we could be in a trend. We could have a stop hunt back into the trend for the continuation move. So again, understanding the difference. Print off your charts, look at the highs and lows. How did they form? What time was it? Where was the entry? They're going to be the same thing this week. They're going to be sell high setups. There's going to be buy low setups. It doesn't matter what market you're trading. If there's a high and there's a low, these behaviors are in every single market. Depending on the players, depending on the timings, depending on the ranges, the spreads, the volatility of that instrument, all of those things will have a bearing on how that trades. So study what you're trading, know exactly what you're doing, keep it simple, stay disciplined, stay focused. Thank you for all the likes and the comments and the feedback. Keep getting better, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading today, continuing our discussion on looking at other multiple time frames and how those other time frame traders play into my strategy when I'm looking at the market. Again, we reviewed the simple steps. I'm looking at the high and low of the day, the timings, the 12 candle window timings, and we're looking at round numbers, engulfments, pin hammers, but specifically high and low of the day. But today we're discussing how I look at the information as the day's unfolding, who is in the market. We emphasize, we talk about yesterday's high and low having significance, and just hammering home when that level is hit, that at that point every time frame now is involved. Obviously, we're not talking necessarily high of the week, low of the week, or monthly traders, but obviously those levels when they're involved are significant as well, because then at that stage even more larger players potentially may be in the market, or larger interests, more time frame traders. So, but as the day unfolds, helping establish my thesis heading into each session, the other time frames are involved. And as we look at the beginning of the week on the British pound, the market opened on a gap from Friday. Immediately, we were already above Friday's high, as evidenced by the blue line. Excuse me. And then as the day evolves, right off the bat, when that first hour's low is broken, we now have hourly traders potentially in the market. And as that second hour trades out, we now have other traders being involved in the market. So the break of that low on the first candle of the 12 candle window triggers hourly traders into the market. So when the hourly trader is now involved, we also obviously have 15-minute, 5-minute, 1-minute traders involved. The break of the previous day's high may have obviously end-of-day traders involved. And as we head into that third hour, they pull back inside. So we're inside of the highs and lows. We have multiple time frame traders involved. The hourly trader who's traded the break of this bar at the low, where that wick has gone through and triggered the break of the previous hour's low, comes back inside of the range, but it also goes above the most recent hour, triggering breakout traders on the other side, possibly. So again, even though they're inside of the high and low, the break of a previous hour at the low of the day has now involved other time frame traders into the market. So traders may have other chart. You can have multiple charts up. But in my head, I know when I'm at the end of the hour. I don't need to look at the hourly chart. So we're looking at the 15-minute chart. And in my head, though, I now have a high of the day, low of the day in place. We're back inside of the range. We're inside. We have a low of the day, but we have hourly traders either still holding on to this down low that sold the break of that second hour on the open, thinking this market's going to go back and fill the gap. We've got end-of-day traders in the market. They may have their stop below Friday's low. Then the market pulls back inside. So we have our 3-hour high and low set in the Asian range. The market comes back inside. So again, we have hourly traders long, we have hourly traders short, and we have people in between who haven't really gone anywhere. Unless they bought the low, they might have taken some money off, whatever, but they're up 10 pips. The market pulls back inside before going sideways and engulfing the peak formation low structure inside before we head into the next 12 candle window. So again, we already have a market talking about three things that markets do. They break out, they pull back, and they trend. They break out, they pull back, and they reverse. They break out, they pull back, and they go into a trading range. So at this stage, we have a market that has broken out. This gap is the same as one large bull candle. That is a bull candle. It's pulled back. And if you look at this chart, this is somewhat of a cup and handle formation. We also have geometry now. We talked about this the other day in the last video. We have a geometrical structure that once it trades through this high, okay, so we've already confirmed that this market is a breakout, and now potentially we have a trending market. So Low of the day is in place, possibly. We have an engulfment in Asia. We want to be trading in the direction, not counter to the peak formation. So the market breaks the high of the Asian range. The peak formation has given us a low structure. We have other time frame traders who are caught down low selling the market. The break of the high in Asia is probably triggered other time frame traders again with the hourly chart. Our 4-hour chart traders would definitely be long at the break of that first bar at the high of the day at the beginning of the Europe-London 12 candle window. So we now have traders caught short, either stopped out. They have stops obviously on the other side of the range. They may have moved their stop to the above the high once Asia pulled back inside. The ones that were short down low. Swing traders, 15-minute shorts, 5-minute, 1 minute, all that scenario. But again, the end-of-day traders are in this market. They've probably now moved their stops to the low of the day once this high is broken. And our 4-hour and 1-hour traders are now buying the break of this as well. So again, if we were to trade, we would be trading in this direction. It's now confirmed as a trend. We have a peak formation low, the stop hunt back into the gap time, into the peak formation low, and then the engulfment and the continuation move in the gap time. So we want to, if we're trading this heading into the Europe-London window, we only want to be trading in the direction of the trend. The market continues to move up. So again, as we head into the new hour, this breaks the high of the doji. That triggers more hourly traders into the market. Okay, the break of this high, as we mentioned, triggered 4-hour bar entries. This triggers the 1-hour trade. The break of the next high triggers more 1-hour traders into the market. And then as we head into our next window in the gap time, the break of the high triggers 4-hour traders and 1-hour traders again up top. 15-minute traders could have been buying the break of this, thinking it was going to continue to blow off. This looks like it could be a measured move structure for a mirror image, except that we know in the timing window, we haven't been into New York yet, and there's a high probability that we're up high, and London was in the middle. Asia formed the low of the day. London's in the middle. We know that the U.S. session is potentially going to put a high of the day in place, whether that blows up another 100 pips and then puts it in, but we get the big death candle. The death candle comes in and locks in that whole upper range. As we said, 3 pushes into the high and a 1, 2, 3, but understanding also that multiple time frame traders are now caught in this market. So again, if you're a 4-hour trader and you've bought the break, your stop may be underneath of the low of that 4-hour candle as it's formed, because we've just triggered it, or they've just gotten in here, one or the other, and the low of that bar is here. They're stopped out right away. Hourly traders are in. If the 4-hour trader has put their stop below the 4-hour bar, it's down here. The first bar of the 12 candle window is the 4-hour bar. Now, gold's slightly different. Sorry, that's correct. It's down here. Gold is slightly different because it opens an hour later than the other major pairs. It has an hour gap time. So when these multiple time frame traders are involved, you want to be understanding where's the beginning. If it's an hourly trader, there are going to be stops underneath these first bars of the hour. Every first bar of an hour is going to have stops for breakout traders who are in the market. We're not even talking about 15-minute bars now. We're talking about the hourly and 4-hour. So again, multiple time frame traders. We have end-of-day traders who, heading into the next day, will move their stops up underneath of the previous day's low. So again, just understanding the psychology behind multiple time frame entries into the market. But again, working the high. We had nothing in this 12 candle window, but we're now in a trend day. So why would we be looking for that? Or be expecting to see that? Like, people just again stepping back, and we talked about the measured move. So the first thing I'm doing when I know it's a trend day is I'm projecting up to levels, and I'm looking at round numbers, and I'm also looking at 50 pip boxes. The range that's set up was in a 50 pip box in Asia. So we're thinking potentially a minimum of 2 levels, but they extend it up and go into the 3rd level. And what do? They pin up and can't quite get there. And then boom, they lock it in. Where does it lock in at? It locks in at double zeros, and they go sideways before continuing the move. So again, once they've locked it in, no matter where I get in, I want to be trading in that direction, knowing that they're going to go back after the money. There's multiple time frame traders involved in this market, but also if I'm looking for an entry and I can't quite get my ideal perfect setup for my M or my W, I will never hesitate to short a bull candle in a down move or buy the break of a bear candle in an up move, especially in the timing window if the move has already locked in a level. Very important for me. And again, it's a 1-bar stop. So we head into the next day. Again, as the range starts to trade, we want to know where are our multiple time frame entries going to occur. Well, obviously they will occur at the breaks of highs or lows. So as the day progresses, until one of these levels is broken, each day in that tighter range, we're going to start to trigger 15-minute, 1-hour entries. But the bigger highs and lows will trigger the 4-hour, and obviously the break of the previous day's high and low triggers every time frame, especially if we're at the low of the week or the high of the week. We get the break of not only the low of the day in the London 12 candle window, but the low of the week. They pull it back. They come back a second time, and it doesn't follow through. They break up higher, pull back, pull away, whether you get in down low, whether you get in once they on the 3rd leg, it doesn't matter. At any point, we never understand. We don't know with absolute certainty. We have a high degree of probability setting up. Okay, they break the middle structure. So whether you got in down low, we had 1 push, 2 push, 3 pushes. If you get in up here, it's still a 1-bar stop. Again, I'm looking for the first target is going to be the high of the day. Why? Because we've put in the low of the day. They've done their work down here. They've pinned through the low. They've hit the low of the previous day. They've hit the low of the week. They've locked it in with an engulfment. They've come back a 3rd time before pulling back and shifting away. We're at the low of the Asian range. The first place I'm expecting is here, but they blow through there. So now my targeting is in measured move increments. We're looking at a 50 pip box. So I'm thinking at least a 50 pip box atop, but they continue it in the US session. If you haven't taken 50 and you're holding on, or you've taken 50 and you've got a trailer, then think 3 levels. 1, 2, 3. We could be targeting the 50 pip box up in that upper 3rd. So again, 150 pip box, you may go for 125 level. You may get out at the quarter and say, okay, I'm gonna take off or trail it tight after it goes through the quarter, whatever that may be. But also understanding, again, the topic of today's conversation, other time frame traders are caught down here. Breakout traders, 1 hour, 4 hour, end of day, they're all caught down here. 15-minute if they're chasing the move on the swings, the breaks, all those things, they're caught. Their stops are typically going to be above the hour, the 15-minute bar, the 4-hour bar, the high of the day. So understanding that there are multiple time frame stops on both sides. They blow through there, multiple orders, big move, pull back a second time in New York. Why aren't they coming back down inside of the range? Because that could allow all of this volume to possibly get out with a smaller loss, no loss, or even a small profit possibly if they come back too far. So again, understanding that when they come back and there's a gap, Al Brooks talks about measuring gaps. If they have a gap, that means this is a strong move. There's a space between the lows and the highs. That's a gap that indicates this potentially is a very strong move. So again, 3 levels. I'd be holding on for this and knowing that after they put this low in the first window, with multiple time frames again involved in the market, and they pull it back and they work it down and they trigger that low, we've now triggered hourly traders shorting the market, 15-minute traders shorting the market, 5-minute traders shorting the market. So again, now more stops being generated up top, engulfment, pin hammer for the explosive move through the high the new high of the day. So again, the days evolve. We have a new high of the day. A peak formation put in place. They work back into it. Traders short the market, and you'll notice as the market falls, your fills, if you're shorting this, get worse and worse, and you're shorting it right into the low before they reverse that on a 3-bar reversal. Okay, so again, timing window. Okay, you're inside. Anything in here is inside. There's no pin through the high to indicate that this has been a stop hunt. Okay, they've locked it in, and you're in a breakout now. They've put the low of the day in place, and you're in a breakout move. First hour typically is a stop hunt trap trade. We talk about this. They roll it over in the equities hour and take you back in the wrong direction. Explode through the high, triggering more breakout traders, more multiple time frame entries in the long trade, which helps propel this explosive move back through the high of the day. I'll get rid of this. I'll just erase this. So we head into Wednesday. So again, high of the week, low of the week. We see the same thing. Market's got multiple time frame entries being triggered up here. Hourly, 4 hour, possibly already in. They pull back into those traders. Doesn't mean they necessarily stop them out. The hourly guy might be stopped out if he's got a trailing stop. 15-minute guy is getting in short now. They trigger multiple stops possibly before going sideways and potentially putting a low of the day in place. So we have 1 push, 2 pushes, 3 pushes into the low before they engulfed it, engulf the low structure. They don't revisit the low, they shift sideways. So again, an example of splitting the box, going sideways, pin hammer, and a breakout. So again, another example of a cup and handle type scenario. Cup and handle we can measure, and 2 full expansions is pretty much where that move failed. But again, just looking at our numbers, we have a 50 pip box. 50, 50, and they get up to the 50 level, which is only 2.5. But again, that upper quarter is where this market fails. So again, we go sideways before they trigger the highs and pull back 25 pips. So again, triggering breakout orders, hourly, 15-minute, and a day. Coming back 1, 2, 3, getting traders to short this market, which again is the handle formation of our cup and handle. And then the reversal and breakout. So this is a 1 hour candle now. The first candle triggers again breakout orders before coming back 25 pips and stopping out traders who are long on the 15-minute, 5-minute, maybe 1 minute, maybe even the hourly, hitting lows. They've moved their stop after the market's moved up. They've moved their stop up to the low. Boom, it pins the stops before reversing and engulfing in that third candle, which is now a 1 hour pin bar, once it breaks the high of that bar. So again, breakout traders trading this all the way up, 1 hour, 15-minute, all those maybe trailing stops, whatnot, and again, boom, pin into all of those traders who are following this move up, trailing it possibly. Again, an example of why I don't use a trailing stop if I was in this move. I have a profit target set, I have my stop loss set, and I don't typically move it until it's right near my target, and I do not trail it. I look to lock in the profits either at my target or just before that target is hit if there's any degree of consolidation or timing window is getting to a close in terms of a 1 hour or a 15-minute candle. If it's been sitting at that level within 10 pips and it goes sideways for 1 or 2 candles, then I'll lock it in. So again, I see this big pin, I'm waiting for more. I might lock it in because we're at the end or heading into the end of our equities hour. That may be the reversal point. Even if they come down 1 candle and continue, that still may be 15, 20 pips into my profit target. So again, the pin triggers other time frame traders potentially, breakout traders, 15-minute, 5-minute, all that, pinning them, hitting stops. But this pin on the bottom now could be an indication of that move. They've done their work. We're going to keep going up if we were trading this. But again, the market in the gap time, what does it do? Hits the highs, triggers breakouts. People say, well, We've got a W formation now, possibly, yep, but we're up high. So when we're getting a W up high, I think that's a trap, or potentially we're in a blow-off move. So again, we get our W taking us up higher in the gap time, but we see the 1, 2, 3, and again, understanding that this last candle at the open of the 12 candle window triggers breakout orders on hourly, possibly 4 hour, 15 minute, 5 minute, 1 minute, all of those, before we get the death candle. The death candle locks in 2 of the 3, actually almost all 3 of the 1, 2, 3s at the end of that middle hour. Consolidation. And again, I don't trade trendline breaks, but I use them as an indication of when a move may be failing. We get the consolidation. We're into the equities hour. We have a bull candle. We get our 1, 2, 3, 4 second hour starting. So again, that first candle, we have a consolidation. I would be prepared to short any one of those candles with a 1 bar stop above that range. At this stage, we've locked in the high of the day. The death candle is my confirmation. We're outside of the gap times. We've gone 3 levels of rise. We now have a trend line break. I would trade this with a 1 bar stop, with my thesis being this should come back at a minimum some point into the breakout trader from that break of the first hour's pin bar high. Let's lower that down 1 candle. Again, it could be the low of this pin on the stop hunt, but that's the minimum, because obviously there's going to be stops down there, hourly stops, 15-minute stops, whatever, trailing stops, all of those things for a move back down. So again, understanding the process, my psychology is, if I'm not up here selling this candle at the open, and I'm getting in later, my narrative on this trade is that death candle has locked in the high of the day. So anywhere in here, 1 bar stop, could be this bar once they break it, could be this bar, but it could be 20 pips and you could be getting in at numbers. It doesn't matter. Once they've given me the death candle and they've had this extended M pattern on 3 levels of rise, I'm in this market for short. But again, understanding that every time we go higher, we're triggering more entries. There's going to be more stops put into the market. Same thing on the downside. So Thursday, we have a trending day. So again, we worked into the low on 3 pushes. They pulled it back. Okay, so we've broken a swing high level. So again, every time we break a high structure now, we're triggering other time frame traders. We have a little W formation in the gap time right off the round numbers. So we have our W right off the double zeros. And when we see a high and a low and we see a W at double zeros, we can potentially have a thesis that this is the midpoint of a measured move. W on top of double zeros after a peak formation low. If we were to measure our lower W structure for our rectangle, we could look at this at a minimum of a quarter level. If it's 3 full expansions, which this market did do, we're looking at 32.25 roughly. And again, that could be the failure point. So I would factor in a spread and start looking for timing windows and evidence of a market blowing off. 1, 2, 3. I'd be taking something off or trailing this, which is where they've pinned it and pinned it again before pulling back. If traders weren't trailing this, or if they were trailing it, they're stopped out. But on a trend day, again, understanding the market is now in breakout mode inside of a high-low structure. We obviously have hourly, 4-hour, 15-minute, 5-minute, 1-minute, all those in place. Once they break this level, now we have end-of-day traders in this market. Traders are looking for a sell setup up here, but look at this sideways price action on top of the high of the day. After a breakout, this is a trend. This is a strong trend. Okay, this consolidation is your key to understanding this move. As we head into our 12 candle window, again, even if you're going long, remember you're going long on the break of a bear candle in a strongly moving market. You could be buying the bull candle. You could be buying the break of the bull candle, but you're still buying the break of a bear candle. And again, when we see this consolidate on top of a high and a strong reversal move, we have 2 structures. We can measure a full expansion of this structure, which the market did not proceed through to, or we can have a measured move on the W as we just showed, down low, which the market did move up to, or we can look at this and look for a 1.5 extension of that range, which the market just went beyond that slightly. It was the full measured distance of our bottom rectangle. But again, this strong move, we're in a continuing running wedge in London. So again, thesis being no problem. This is a trend day. We're expecting then that the U.S. session will be putting a high of the day in place. Traders were emailing me asking me, well, where was the sell in London during this London session? I'm like, you're in a major trend right now. We're in a running wedge. Okay, so you want to be following this market up and just drawing your parallels. And then we get the 1, 2, 3. Okay, so we're in the gap time. We get the 1, 2, 3, pinning down. It's messy. So again, understanding that if we don't see something that looks fairly simple in textbook, okay, even if you're shorting the break of the pin, okay, if we don't see something clean up here, then we're going to have an assumption or a thesis that they're working down maybe in 3 pushes, and they're going to revisit this because they're making you chase. Whenever you're chasing a trade, if it's not up high and it's clean, simple, okay, if you're chasing a move down, as soon as you sell here, you're 25 pips away from your high. But again, we don't have any middle structure. This is just a blow off. We don't have an M formation. We don't have a 3-bar reversal. We do, but not the clean type. Again, you're chasing the move unless you short the peak bull, the high bull candle. You have a 1-bar stop. You're selling it down here. The first mouse has a bit of heat. He sold down here. They pull it back right away. The second mouse, he's in clean. So again, the market pulls back, goes into consolidation before extending down more than 50 pips from high to low. But again, they made you chase the move unless you were selling after the pin on the pin bar, selling the pin underneath the numbers, above the quarter level, above the 50 level, and your thesis being, at least to the low of the beginning of the Europe London 12 candle window, which they did, but they made you chase the move. Whenever you're chasing the move, your fill is worse. So be thinking sell high. If you have a reason to sell high, and a 1, 2, 3 blow-off move is a sell high setup, it's still going to be a 1-bar stop. Even if you're in the gap time, the closer you get to the 12 candle window, I would be prepared to sell high and get in up here, maybe on a shorter time frame. But again, understanding that as I head into that window, I might be taking profits. I might not hold on for 50 because I know they could still come back depending on how this plays out. So again, I might be taking profits and then looking to get back in again. This engulfment and pin to the low, chasing a move down here, selling down here on a close of a candle, you have to be saying to yourself, you're trapped. This triggers other time frames selling as well. Hourly, 4-hour, this break of this low structure, this stop hunt triggers 4-hour entries. Okay? So remember, multiple time frame traders, these stop hunts not only clean the board off of money, but it triggers other time frame traders. And so if they trigger other time frame traders, 4-hour, 1 hour, etc., where are their stops? Most likely going to be. They're going to be above not only maybe the 4-hour bar, the 1-hour bar, they're going to be at the high of the day, all of those places. So if a market starts working its way back up and you're trading this in the U.S. time, understand that there are stops up here for the traders that have been triggered into that market, which is just understanding if you're looking for that swing back down, remember who's caught, who's underwater right off the bat. They got into the trade, it was going down, that was a big candle getting ready to blow off. They chase the move and bang, they're underwater 25, 50 pips. So again, here we go. Any break of a low or a high, we definitely now have triggered 1 hour, 4-hour entries. So these traders, obviously 15-minute traders are in the market, 5-minute, 1 minute, all of those time frames. But the lower we go, we now trigger more 1 hour, possibly more 4-hour traders. So again, they trigger the 1 hour trader down low. There's 1 hour traders caught selling down low. There's your W. Once they've triggered these 1 hour traders, you'll notice that second leg of the W doesn't allow them to get out. It doesn't go low enough. It stays just above the low bar where they may have gotten in on the break of that candle before coming back 25 pips, pinning up into the Asian high. Okay, again, there's the pin. Okay, so understanding this may now be the high of the session, the new high of the day. They break the low of that bar. They come down, and what do? they hit the low of the traders who have gone long. We've got our little micro M structure inside for that sell back down. And what do? They come back up 1, 2, 3 into the traders who are short, 25 pips. So again, most stop hunts are 25 to 50 pips. And again, the market goes sideways. Breakout traders, 15-minute bars are in the trade, 5-minute, 1 minute. Oops. And again, 1 hour traders were caught down low. This is the first candle of the middle hour. So breakout traders are now caught. They're caught down low. And then there's a 25 pip stop hunt into the trend. So again, traders 1 hour, 15-minute, 5-minute, 4 hour. 4 hour traders are caught down here. And they go 25 pips back into their trade. So it either stops out the shorter term time frame traders, especially if they have size on their trade, but it also puts heat into traders, makes them second guess if it doesn't stop them out. And then we get the move, the 50 pip move from high to low down to the low of the day, triggering even more other time frame traders. And that market now comes back 25 to 50 pips just before our 12 candle window. Some traders are long. Where are their stops? Right here. We get a death candle. They engulfs the whole upper structure. Okay, it engulfs the whole upper structure just as we head into our 12 candle window. I'm short. I'm expecting them to go after the money. There's our extended M formation. Okay, at the high of the day with a death candle. Engulfment. Drops down 25, hits the stops, pulls back 1, 2, 3, gets traders who have gone to break even, goes sideways, continues the move. You can sell a bull candle in a down move. It's a 1 bar stop. So 1 push, 2 pushes, pins back up into traders who chase the second leg. So even if you're holding on, you didn't take any money off the table. This guy's got his 50 pips. This guy's up 25, hoping for 50. They pin back into him, go sideways, and engulf, pull back inside with a bullpen hammer. Now we know they've locked in the low of the day. But before they did that, they triggered hourly, 15-minute, 4-hour traders into the market, as well as end-of-day traders who have now maybe moved their stops to above maybe the U.S. session high or somewhere in there. And isn't it interesting how they closed out the week? All these traders who chased the swing back down are caught up here. Traders who sold on these other time frames down low are all caught if they're not stopped out. End of day traders are caught right now heading into the weekend in negative equity. So guess where their stops are? If they're not above the U.S. session, they're at the high of the day, and they may have locked in the low, and we may have a bit of a W structure for a move back up, at least to the high of the U.S. session. Again, where's the money? We have 3 levels of drop. We have stops above all of those levels all the way back up to the high of the day. Multiple time frame traders caught down low. We'll see what happens. But again, in my head, I'm always asking myself, who's caught? What other time frame traders have just been brought into the market? And when we hit these previous day highs and lows, I know everybody's in. So hopefully you got some value out of today's video, traders. Have a great weekend. Stay disciplined, stay focused. Happy holidays. Get ready for Christmas or whatever you're celebrating. And next week will be interesting. I'll be trading as per normal, except on the holidays and the days before the holidays, knowing that they will be quieter when the U.S. and other markets are not trading or closing early. So enjoy your weekend. Thank you again for all the comments and likes. Hopefully you got value from today's video. Keep getting better, and may the markets
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined and may the markets go with you.